And today we are talking about loans, just loans, loans, loans. So today I'm just going to kind of go over all the different kinds of loans there are. So most of the time, all you're going to hear about are FHA, Federal Housing Authority. These are government-backed loans. So because they're government-backed, banks are willing to take a little bit more of a risk. So they might take you on if you have not a great credit score. You have a lot more or a lot less down payment. And then the interest rate on those is going to be higher typically. And the mortgage insurance you cannot get off unless you refinance it. So FHA is a great loan for somebody who just falls outside of the box of a normal conventional loan. Conventional loan. So conventional loan is what most people get. It comes in a wide range of down payments. You can do 3%, 5%, 10%, 15%, 25 or 20 and 25%. Above that, you can put more down, but above that, you're not going to get any benefit on your interest rate, and the mortgage insurance is going to be gone. So there's really no reason to go above that, except maybe if you want your payment to be a certain number. So you can do it for that reason. On both FHA and conventional, actually all of VA, USDA, there are specific caps on how much the loan can be. So in the city of Portland, it's about $548-ish thousand every year. It can change, it doesn't always change, but the government actually decides, hey, your median house price is this, so we're gonna allow conventional loans up to X. And so, like I said, that can change, but it doesn't always change, and it's dependent on the federal government. VA loans are, of course, for veterans only. You have to have your certificate, your veteran's certificate. That certificate goes towards you being able to qualify for the home. It's actually for the home loan. It's actually a guideline that has to be satisfied before they'll give you the loan. And there's a limit on how much you can be loaned at any given time. So let me explain how that comes into play. None of these numbers are true, so I'm just going to say that, but I'm doing this because it will be easy to figure the math. Say the loan limit for all of your loans as a veteran are $400,000. You could have a principal residence and maybe buy a second residence after a certain amount of time. But the total of those two loans cannot go above what your certificate is. So if it's $400,000, you could have two houses with two loans at $200,000. This is super important because a VA loan is unlike any other loan you can get. You can get zero down. The interest rate's mind-blowingly unbelievable. Like, I mean, I've seen ones in the last 6 months that were almost 2%. So they're a really great loan if you can get them, but there are a few hoops you have to jump through to get it. The other loan that you're going to see pretty often in Portland is called a jumbo loan. A jumbo loan is a loan that pretty much you can get through any bank, anywhere. It's just going to fall above those conventional loan guidelines or conventional loan limits. So typically it's going to be what they call in the private sector because the federal government isn't backing that loan. Again, there's a quasi-governmental organizations called Fannie Mae and Freddie Mac and Sallie Mae. All of those organizations back loans, so they actually have a whole marketplace where they're selling and buying conventional loans all the time so that banks continually get fresh money into their accounts so they can continue to make loans. And it's the loan cycle of life. So jumbo loans are above that limit, and so they're a different market that is not backed by the government and sometimes a little more risky, so oftentimes the interest rate is a little bit higher. or the guidelines are more strict. So your credit score has to be higher. You have to have more assets in the bank. You have to have more income, that kind of thing. And then in all of this, if you looked at an umbrella, the two things you could have in all of these is a fixed rate or an adjustable rate. Most people across the board are doing fixed rate interest loans. So what does that mean? That means day one, my interest rate is this. Day 5,000, my interest rate is the same. That's what most people are opting for because the interest rate is so low. When I got my first house, I actually got an adjustable rate mortgage because typically in a higher interest rate market, the adjustable rates are lower and then they start ticking up. So I think I bought my first house at like 6% interest rate, and that was way better than what was normal, because normal was like running around 7-ish, 8. So it makes a big difference and it makes it more affordable. And usually that was, for me at least, it was an FHA loan. There's a bunch of other loans out there too, of course. So if you have any questions about anything, just let me know. I have great lenders to refer you to. But I'm always interested to hear what questions you have about this. This world changes often and is super complex. If you want to check out other videos that we have about loans, go to our YouTube channel, Paris Group Realty, and we'll see you next week. Take care.